All right, it's just gone 10 o'clock by my watch, so let's get started. Welcome, everybody. Great to see so many people here today. We've got people from all over the world, Denver, Tasmania, Connecticut, and Thailand. So people from all over, which is great. So just wanted to basically welcome you to the community. I know some of you are fairly new to following me on Twitter or email. So I just wanted to sort of introduce myself, do a quick Q&A, and go through a little bit of my process in terms of trading options. So no sales pitch or anything today. Don't worry about that. I hate when you get on a webinar and it's 10 minutes of content and 45 minutes of sales pitch. So there won't be anything like that. Just going to be 100% value, 100% content today. So I hope you enjoy. Just before we do get started, a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So a little bit about me. I've been trading options since 2004. My first option trade was on an Australian retailer called David Jones, not Dow Jones. I bought a put option because I just learned about these things. I always knew, growing up that you could make money when stocks went down, but I didn't really know how you could do it. And then I read this amazing book, and it had information on all different asset classes, stocks, bonds, real estate, commodities, and then there was this one little section on options. And I was reading this in the Cayman Islands. I just moved there. Hurricane Ivan had just hit, so our house that we were living in had got destroyed, and we were sort of rebuilding. And I read this book, and I was awake all night. It was unbelievable. I'm just like, oh my gosh, these options sound amazing. This is exactly what I've been looking for. This is how you make money when stocks go down, and how you can protect your investments. So from there, did a few. Yes, it will be recorded. Did a few Australian trades, which was difficult because I had to do them by phone, and it was like $25 in commissions. It was crazy. So that was back in 2004. 2010, I started Options Trading IQ, and I've been teaching people about options ever since then. So trading about 21 years now, and teaching people for the last 15. So yeah, it makes me feel a little bit old saying that actually. But yeah, lived in the Cayman Islands for about 11 years, worked in the hedge fund industry there, and then moved back to Melbourne in 2015. So that's a little bit about me. Shoot me an email if you want, tell me a bit about yourself, and where you're at. But I want to go through a little bit of what I do on a daily basis, in terms of my process. I always have a few main charts that I look at. So the S&P 500 is obviously the key one, and a few things that I'll point out here. Obviously, we've got higher lows and higher highs. We're in a really nice uptrend. And one of the main things I look for is these moving averages. When we're looking to try to find a bottom in a stock or an index, see we had this big downtrend here through April with all the tariff dramas and all that. The 21-day moving average, the green line, is sort of our shortest term one. That tells us early whether there's a trend change. And once that started declining, that was kind of the clue that the trend might be changing. And you can see we always hit support and resistance around these key lines, right? It's amazing how often it happens. And look here, breakout above the 200, then pull back to retest of the 21 here. So moving averages to me are very, very important. And then once we're looking for a bottom, we look for this moving average to kind of flatten out and start to turn upwards. So this is where we sort of thought, okay, maybe there's a little bit more to this rally than just a counter trend rally. Broke above the 50-day, came back and tested the 50-day successfully, broke out above the 200. So we're getting lots of clues all through here. The 50-day here flattened out and started to turn upwards. And once we've got these upward trending moving average lines, that's very, very good. These are simple moving averages that I use. Yep. So that's the first thing. And I've got an image that sort of demonstrates that as well. This is for Investors Business Daily, their sort of ideal buy point. I write a daily options article for Investors Business Daily if you haven't checked that out. And also write a daily article at barchart.com, as well as obviously optionstradingiq.com. But similar idea here, we're looking at the 200-day moving average, but you can basically use any moving average. As we saw, the 21-day moving average gives us kind of the earliest signal, and the 200-day moving average is more of a long-term signal. But basically what we're seeing here is the stock in a really bad downtrend starts to form a bit of a base. This is a stage one base. The moving average starts to stop declining so rapidly, starts to flatten out, and we get that successful retest here. We get a breakout above resistance and a successful retest, and the moving average starts to turn upwards. So that's the sort of setup I would look for to go long on a stock. And then we can do the exact opposite if we want to implement a bearish trade. Basically the same thing. The 30-week, 200-day, doesn't matter what the moving average is, but again, 21-day short-term signal, 200-day longer-term signal. My favorite is probably the 50-day because it's kind of middle ground, right? So here we've got stock in a huge uptrend. It starts to, whatever the opposite of a base is, it starts to distribute. The moving average flattens out. We break down through support and then we retest here. So great short candidate here or bearish candidate here. Similarly here, we've got a consolidation period. Moving average is still trending downwards, and then we break down through support. So another good entry point there for a bearish trade. So that's one of the first things I'll look for. The other things I'll look for is what's called divergence. I've got a couple of examples here. And again, what we're looking at here, we can get a little bit of an earlier signal here. This is ABV, had a nasty decline. And what's happening here, we had a bottom. It rallies up, look at that, tests the declining moving average and fails. Comes down and sort of retests that bottom. Now, it's a better signal when we get a lower low. So if, for example, if the stock had gone down to about 125 and this line was sort of trending down like that, but this is an equal low, so it is still considered divergence. We're getting an equal low, but RSI is putting in a higher low. And that just shows us that the strength of the rally is starting to decline. Sorry, the strength of the selling is starting to decline a little bit, and then buyers are sort of stepping in. Just keep an eye on the comments, that's why I keep looking over the other way. So that's another little signal. And then the other indicator I really love is this accumulation distribution indicator. And this tells us if the line's going up, the stock's being bought or accumulated. And if we see that in a downtrend, it can be a sign that the stock is starting to bottom out. So we're seeing that here, positive divergence on both RSI and accumulation distribution. Sometimes I just say the AD line for short, but don't confuse that with the advanced decline line, which is different. So nice divergence, and then it goes on a really nice rally there. And we got alerted a little bit earlier of that one than following the moving averages, but also the 21-day flattens out here, gets above and holds above and goes on a nice little rally. Then the opposite, of course, we can also have the bearish type of divergence, and this was Tesla 2023. Pretty good example here. The stock's putting in a series of higher highs, but RSI is kind of declining. So the strength of the rally is starting to decline. The stock is making higher prices, but there's less strength behind that latest rally. And then we had a pretty big decline from there. I haven't got too many current examples to show you, but I'll try and find one. Here's GE that had a decline last week, and we sort of saw that. If I can add some lines here, the stock put in a higher high, also declined on that day, retreated from the high, and we had some good negative divergence on RSI. So that was one. I'm sure there's some bullish examples as well, but I haven't really got too many. But here's another bullish stock. Again, that 50-day moving average flattens out and turns upward. The 21 flattened here and turned upwards. Really nice entry points here on a great stock. And once these moving averages start to expand away from each other, and we're also seeing masses of accumulation here. So very, very bullish. It's a little bit overbought, but there's so much strength behind this rally. I would expect this to continue for a little bit longer. I might actually just turn my video off so that you can see more of the screen. And I just need to change that to get rid of my name on there. There we go. Hopefully that's better. So there's a really good, strong, bullish candidate. That's the type of thing that I'm going to be looking for. Any questions so far? Feel free to chime in. Hey, Bill, yeah, it could be a Wyckoff stage 1. I'm not an expert on Wyckoff, however you say it. But yeah, I think it follows the IBD kind of process as well. I generally just look at the daily charts, yes. We'll get into sort of trading strategies in a minute. But yes, mostly daily because I'm more of a traditional minimum 30-day option trades. Sometimes I'll even go out to 60, 90, even 120, 150 days. So I'm more of a long-term option trader. If you were doing weekly options or, other short-term options, you'd probably look at a 30-minute chart or something like that. But generally just looking at the daily and the weekly as well sometimes to get that longer term picture as well. But yeah, good question. A couple other things I look at on a daily basis. I usually look at this parabolic SAR indicator as well. When the dots are below the candlesticks, that's a buy signal. When it's above, that's a sell signal. We got a very short-term sell signal here, but that reversed very quickly. Sometimes it works really well in trends and you can catch a big move like this. Other times there's a bit of noise and a bit of chop where we get, a couple of days of sell signals here and a couple here, but the trend sort of remained intact. And we're basically looking at trying to look at as many data points as we can to get a picture of the overall market, and then we can drill down into individual stocks that we like as well. So first thing is we're looking at the overall market, and then we drill down into individual names. This one here, these are all indicators on stockcharts.com, by the way. And you can get these all for free. You don't need an account or anything like that. This one's showing us the percentage of stocks above the 50-day moving average. What I look for in this one, we typically want more than 50% of the market being above their 50 and the 200-day moving average to consider it a bull market and an uptrend. So I'm generally watching this sort of level here, 50 to 55. And we got, again, earlier warning indicators in early March when things started to decline. So this is what we would call a breadth indicator. And once the breadth starts to break down, that's when we can start to see a bigger downtrend. And that sort of happened all the way through to April. So anytime we're below 50%, I'm looking at more sort of bearish trades or hedging my long positions, things like that. Once we're above 50 to 55, it's sort of game on. We're back into bullish mode and we're at a very high level here. We're looking pretty good. And we also had some really strong breadth last week. We'd sort of been hovering around that 50 to 55 level. Really strong breadth last week on the 200-day moving average. So this is the number of stocks above their 200-day moving average. And again, once this breaks below 50, that's a little bit of a warning sign. And that's when we, be a bit more cautious. We hedge some trades, things like that, or we might take profits earlier. Also, the advanced decline line. This is probably my least favorite out of these ones that I look at. But again, we just get an overall view of the market and we saw a big uptick in this indicator, this breadth indicator. So a lot of advancing stocks last week. So again, very, very strong breadth in the market at the moment. Always take a look at the VIX and mainly what I'm looking at here is, is volatility high or low compared to the range of the last 6 months? And currently we're at 16, and that's one of the lowest levels we've seen in the last 6 months. So volatility is quite low at the moment, which isn't ideal for an option seller, right? It's typically what I do is I'm selling options, condors, credit spreads, wheel trades, that sort of thing. Those are my three sort of bread and butter trades. Now, it doesn't mean that we can't make money as option sellers. It just means when volatility is low, those normal strikes that we would sell, and for me, that's around a 15 delta. We'll get into that shortly. Those 15 delta options are going to be a little bit closer to the stock price when volatility is low. When volatility is really high like this, that same 15 delta is way further away from the stock price. I could probably do a whole session on volatility, but that's just kind of a few little basic tips. And then this last one is one of my favorite things to watch. Some of you who, if you've followed me, I think most of you are fairly new, but if you have followed me for a while, you'll know I look at this pretty regularly. This is one of my favorite things to watch. And It's called the VIX futures term structure, but don't let that confuse you. It's pretty simple. It's basically just saying, what's the volatility of S&P 500 options for the July expiration, August, September, etc. Volatility for July is fairly low. As we go further out in time, the volatility slowly gets higher. Now, again, confusing name. Don't let it scare you off, but this is what's called contango. Okay. It basically just means low volatility in the short term, higher volatility in the longer term. That is what we're going to see the majority of the time when the market is in an uptrend. This is what we would call a normal market condition. This is a way to kind of gauge the level of fear in the market. And at the moment, there's really no fear. It's very, very calm, and that's what we want. Now, when it goes opposite, when the short-term options are higher in volatility than the longer-term options, so we would get like a Nike swoosh kind of curve like this, and I'll show you an example. Just open this up. I should have had this pre-prepared, but I did not. Here we go. So this is from the blue line is February 5th, 2018. Bill, you're a legend. You've got it, backwardation. So the opposite of contango or the other scenario is backwardation, where we have high short-term volatility and then it goes lower as we go further out in time. It's not really a Nike swoosh, is it? It's like a slip and slide or something, a water slide. Okay, backwardation. So if you only remember one thing from this session, let it be this. And this is one of my favorite market sayings. And it's bad things happen in backwardation. Okay. So when the market goes into backwardation, which happened the day before, which was the Friday, we went into very slight backwardation. And then Monday, we had the big decline and the massive spike in volatility. This was a day called Volmageddon or the Volpocalypse. A couple of hedge funds blew up. Volatility, the VIX rose like 115% or something. It was the biggest rise in the VIX, the biggest daily rise in the VIX on record. The VIX wasn't around in 1987, which probably would have been a bit higher, but this is the highest. So bad things happen in backwardation. Now we can find this again for free if we go to vixcentral.com. And when the market's in an uptrend and everything's calm, I only really check this once a week or not even really that often because I know the market's calm, there's no issues. I'd only really start to check it more regularly if we start to correct. And sometimes we'll have a little pullback and the news headlines might be saying, oh, the market's going to crash, the market's going to crash. But if we're still in contango, we know it's just a normal run-of-the-mill profit-taking kind of pullback and we know there's no panic. But if we go into backwardation, that's when people panic. That's when there can be forced liquidation, margin calls, and that's when we get the big declines. So at the moment, there's a huge percentage difference between the first front month and the second month. So I'll keep an eye on these. Very, very calm market. Absolutely no panic, as you would imagine, right? Because we're just continuing up every day. Once these percentages start to get smaller and the curve starts to flatten out, that's when I'll start to check it more regularly. All right, so bad things happen in backwardation. Always remember that one. The other thing to note, wrong image, sorry. When we talk about DTE in options, days to expiration, people who trade really short-term options, let's say you're an options seller and you trade weekly options, you've got negative vega, or another way to say that is your short volatility. Volatility going up is going to hurt your position. Volatility going down is going to be good for your position. That's generally the case with options selling. Now, if we get a big drop in the market, a little bit of a panic, and we get a vol spike, the short-term options are impacted the most. So it's gone here from about 15.5 to 34, over 100% jump. Whereas if we're trading out 90 days on the curve, it's gone from 15 to 21 or 22, nowhere near as big a jump in terms of the percentage. So on a day like this, when this happens, short-term option traders get absolutely crushed. Zero DTE, weekly options are going to get hurt really, really badly. 90-day options are not going to be impacted nearly as much. So I like to be out in this area of the curve to try to avoid this situation. So a lot of my trades will actually be sort of 90 to 120 days to expiration. Now, the other difference with short-term and long-term trades is that short-term trades move really quickly. The P&L will fluctuate really rapidly, minute by minute almost on those weekly options. Whereas with a long-term trade, 120 days, nothing much happens on a daily basis. Very, very slow moving. So for me, and it's all personal preference, right? For me, this kind of makes more sense because of the time difference for me. I don't want to be up all night trading the US market. I want to get some sleep. I want to have lots of slow moving trades that I can just check once a day. And what I actually do, I'll show you in a minute, is I set price alerts. And if my price alerts go off or don't go off, I know the trade's fine. And I'll sort of show you how to do that. So that's a way, if you're time poor, if you're still working, can't be in front of the computer all day, or you're based in, Thailand or Tasmania or wherever you are on the other side of the world, and the time difference is a challenge, you can do longer term options that move really slowly. All right. A couple other things that I do on a daily basis. I'll use bar chart. This is probably the only paid product that I recommend. I work with bar chart, write daily articles, do videos for them, etc. Have a really good relationship with them. Great company. Hey Bill, in between swing and position trader, I would say for me, yeah. So I'll have some shorter term option trades, and then I'll have longer term sort of wheel trades, which are more long term positions for me, where I'm trying to increase my dividend income more in sort of my retirement account. So I kind of split things 50-50. So on a daily basis, I use these stock screeners, and I have a couple of the main ones that I use is this one here, 20-day moving average screener. And this is going to show me, good option volume stocks, highly liquid stocks that are breaking above or below a 20-day moving average. So I'll always scan this sort of every day. This will be where I get more new trade ideas. So we've got Oxy that's breaking below the 20-day moving average, and then all the others are breaking above the 20-day moving average. The other reason for looking at these indicators is I get an overall feel of the market. We're seeing lots of buy signals here, so we know the market's in a good uptrend. If the market's still sort of going up, but we're starting to see a lot more sell signals appear, again, that can just be a little early warning indicator that, there's some weakness in certain sectors or underlying areas of the market. Maybe we can get an early warning that there might be a correction coming. So I'll do the 20-day moving average screener. I'll do the 50-day as well, and I'll do the 200-day. So again, looking at how many green and how many red ones we're getting to gauge the overall strength or weakness of the market. And then I'll drill down into the actual stock and see on the daily chart if there's any sort of trade that might be relevant. So, what I'm looking at here, we've got kind of mixed signals. We've hit resistance at the declining 200-day here, but we've got a flattening 50 and a rising 50 now, and it's holding a support. So kind of conflicting signals with the moving averages. We're also seeing a lot of distribution here. So probably a little bit more bearish than bullish, particularly when a stock's below a declining 200-day moving average. That's kind of a potentially good bearish candidate. A lot of, the big mutual funds and hedge funds, they are not allowed to buy stocks if they're below the 200-day moving average. It's part of their constitution or whatever you call it, their offering documents. So when a stock's below a 200-day moving average, there's going to be a bit of a lack of buying support. So I would tend to lean a little bit more bearish than bullish, but again, like I said, conflicting signals with that rising 50-day moving average. So, maybe it's just an avoid for now and maybe not go into any particular trade. The next one was Pan W. Nice little breakout above the 21-day moving average. We've got nicely upward trending 50. We're above the 200. The AD line is reasonably strong. So reasonably good bullish candidate there. It's got the potential to maybe break out of the resistance here. Now, one of the other things that I watch on these charts is this RSI, and I'm going to draw some lines again here. In a downtrend, which we had here, we get these little counter trend rallies. All right, counter trend rally. RSI struggles to get above 50 to 60 when we're in a downtrend. Then when we're in an uptrend, 40 to 50 sort of holds as support. The stock's in an uptrend. We have these little pullbacks to the 50 RSI, and then it starts to rally again. So you can kind of see that here. In the downtrend, couldn't get above 50 on RSI. In the uptrend, it's holding above 50 RSI. So nice bullish candidate there. What some other ones? CRM breaking above. And I'll just kind of go through these until I find some ideas. And this is just one way that I'll find ideas. So CRM, again, a little bit of mixed signals. We've got resistance at the 200 here. We're below the 200, but the moving averages are flattening, starting to turn up. We're seeing some good accumulation here while the stock's kind of consolidating sideways between this sort of 260, 275 range. We're seeing some pretty good accumulation. So it's a little bit early, but it's a potential bullish candidate. There's probably better bullish candidates out there. Anything on the 200, nothing much there. So there's not a huge amount of stuff today. But then I'll obviously look at all the big names as well. And there's probably 20 to 30 of the big ones that you could look at. Amazon, I think, looks really good. The 50 has flattened out, turning upwards. The 21's rising, holding a support. Accumulation distribution's pretty good. And where RSI 50 was support on the pullback. So Amazon looks really good. Nvidia, obviously, really good. Looks really good. Nice moving averages, a nice accumulation line. If you've got any other examples you want me to look at, drop them in. I'll also run a scanner for upcoming earnings if I'm going to do a specific earnings related trade. Implied volatility is always very high around earnings. We're not seeing it here. It might not quite meet the option volume criteria, but Delta Airlines is reporting. If I'll just drop this down to maybe 2,000, we might see Delta, which is reporting this week. Not seeing Delta. Maybe it's, or it could be my market cap. Earnings is kind of kicking off this week. There we are. Delta Airlines. Yeah, the market cap was below 40, but Delta Airlines is a good stock, good volume, right? It's reasonably bullish. Again, we're below the 200, which is a little bit of a concern, but the 50's flattened and is turning upwards, holding a support. So, that could be an okay candidate. Again, below the 200 is a little bit of a concern for me, but it's not too bad. Someone asked for Home Depot, Nicholas, yeah. Yeah, bit of a mixed bag, sort of caught in between the moving averages. The accumulation's been pretty strong here, but that could be a potential condor candidate, right? Stuck between these moving averages. That's an example of something where I might look at a condor. Indicators, Bill says indicators are delayed, price action is more real time. Which is your preference? Really good point. So price action is always number one. So what was the other one? CLS. Great price action. That is the number one thing you look at, and then the indicators are secondary. Ideally, you want the indicators to confirm your view of the price action. If the price action is good, but the indicators aren't confirming, you might hold off, but you could still enter the trade because, yes, as you probably said, and as I said, price action is the most important. It's a really good point there. So that's earnings specific trades. I'll show you some in a minute. A couple of other screeners I use here. candlesticks, I'll look for bearish and bullish engulfing. It's another way to potentially find some bearish trades or some bullish trades. There's lots of different candlesticks here, but I usually just use the engulfing ones. And then here we've got some bullish engulfing candlesticks. So that's another one. Some of the pre-made bar chart ones are pretty good. Top tech stocks is pretty good. RSI overbought, oversold, nearing 6 months highs, 52-week high top picks. Those ones can be okay. And I've got lots of other ones here that I sort of use. If I'm going to do a wheel trade or something that pays a decent dividend, I might look at something like this, which could give me some high dividend stocks that I might like to buy in my retirement account, increase that dividend income. So then when it comes to actually placing the trades, I'll always come into here to my broker account. This is Interactive Brokers for those that use Interactive. That's probably the best version or option for Australians. The US, you might want to use Think or Swim, but Interactive Brokers is good as well if you're in the US. This is part of their trader workstation platform called Risk Navigator. And if we set up some trades here, I'll show you, if I was going to do a naked put or a cash secured put on Delta Airlines for earnings, this is probably the only time I would actually use short-term options. I don't really do it that often, but the volatility in these short-term options is really high because of earnings. And actually, we can go and look at that and you'll see a current example of backwardation. Now, it doesn't mean, because with an individual stock, we have earnings, whereas with the indexes, we don't. So we're going to see backwardation here, right? Backwardation. That's very normal. So when you see this on a stock, it doesn't mean bad things happen in backwardation, right? This is just because of the earnings. Now that volatility is really, really high because of that earnings announcement. There's a lot of uncertainty. So we can take advantage of that by selling options around earnings with the high volatility if we like the stock, right? Hey, Ian, yeah, I pay like $10 a month, I think, for the data feed with IB. If you email me, I'll send you the exact parameters of the data subscriptions that I have. Tasty Trade's good. Yeah, Tasty's okay. The commissions are good. I find they don't have anything like Risk Navigator, and I would really struggle to trade without Risk Navigator. It's okay if you're going to do basic trades like naked puts or credit spreads. If you want to do anything a little bit more complicated than that, it's not going to be great. But yeah, it's an okay option if you're doing pretty simple option trades. So really high volatility here. So we can generate a lot of option premium. If we sell that $49 put, let's add in some dates here. This is our expiration date payoff graph. So we're going to generate $150. That's our max profit. We're on the hook to buy 100 shares at 49. If it drops below that level, our break-even price is about 47.5. So pretty good. That's our expiration profit and loss. Then I'll always add in what we call a T+0 line. Let's zoom in a bit here. This is purple line is what we call a T+0 line. Stands for trade date plus 0 days. This shows us how the trade is going to perform today. Stock goes up, we make money. Stock goes down, we lose money. And this is what the trade will be at expiration. And as each day passes, our profit will slowly drift up towards this blue line. Or if the stock's down, we're still drifting up, but we're actually losing money down here. So that's an example of selling a put for earnings on a stock that we're willing to own. I'll walk you through that spreadsheet in a second, but I just want to grab another one. When I'm doing a cash secured put, naked put, wheel trade, I'll always use this little calculator. Some of you may have this calculator already. If not, I will add a link in the video description where you can download it. Gives me some stats on this cash secured put that I'm going to sell, potentially sell. I put in the expiration, and actually I should have used the expiration for this week because that's going to be the highest volatility because earnings is this week. Should have actually used this one. And this is actually good. We'll add both in and we'll compare the two. Now, don't worry about the risk graph for now. What we're doing is just comparing the two. So, first one, July 11th expiration date. Just need to fill in these green cells and the calculator will do the rest. The stock price is 50.8. Our strike price is 49 and the option price is about 128. If we sell one contract, we're going to get $128 in premium. And if the stock stays above 49, it'll expire worthless. That's our profit. If it drops below 49, we have to buy 100 shares at 49. Our cost basis is the 49 less the option premium, 47.72. The main things I'm looking at here are these two numbers. What's the decrease to my break-even price? So I've got a 6% margin for error. The stock can drop 6% this week and I'm still going to break even. My annualized return is 195% if that expires worthless. That is a huge return because we're generating a large amount of option premium in a short space of time. And that's because of earnings. See, the volatility here is 70%. The volatility on the stock is 49%. This particular option is 70% and this option is 58%. Because remember, we're in backwardation. The short-term option has higher volatility than the longer-term option, which is good for us because we're selling that short-term high volatility. If we compare to the other one, so 12 days to expiration, we're selling the same strike price, but we're getting 157. Similar margin for error, much lower annualized return. Still a really good annualized return, by the way, but much lower. So if I was willing to sell a put option on Delta Airlines, why would I choose this one and not this one? I would always choose this one because the premium's not that much more, but the annualized return is way higher. Now that's an earnings specific trade and there's risks involved with that because I've seen it many times where the stock will drop 20% on earnings, right? Usually if it's a blue chip stock, you're generally going to be okay. And if we go on, this is another free platform that I use just to check earnings. Let's go and have a look at NVIDIA. We can actually look at Delta as well. You know, generally it's not dropping too much on earnings. It did drop a little bit here and here, but generally it's staying above that strike price. Delta has a pretty good history. The last few earnings, it's actually done quite well. Bill says, do I prefer to buy or sell options around earnings? How much does volatility crush affect your decision? I prefer to sell options around earnings because of the fact that the stock can drop and we can still make money because, as you said, we get that vol crush. Again, we're only sort of lightly touching on volatility today. It's sort of a huge topic. But yeah, we're playing the volatility crush by selling the options. If you buy options over earnings, you need to be correct on the direction and you need the stock to make a really big move. So I definitely prefer to sell options over earnings. Only on stocks that I really like though and I'm willing to buy for the long term. Now what you can do is you could also do a spread. Let's say you didn't necessarily have 5,000 available to buy 100 shares of Delta. You could do a bull put spread. So this is another of my most common trades. Now again, not necessarily over earnings. So to buy some protection, depending on how far out you want to go, I usually do 5 points wide, but it's a little bit of a different story with earnings when we're so short term, but I'll sort of do 5 points wide to give you an example. Now we're generating $100. So similar amount of premium. We're only giving up about $28 in premium, but our risk is capped at 400. So it's a much more efficient use of your capital. Here we need 4,700 just in case we get assigned on the shares. Here our maximum loss is $400. Here we're getting a 2% return, 2.5% return, which is 195 annualized. with the bull put spread, we're getting a 25% return in, what was it, 5 days? 365 days in a year divided by 5. Our annualized return here is 1,825. Now, don't want to get carried away with the big numbers, but that sort of shows, how much more efficient these ones can be. And you've capped your risk on the downside. Delta could go to 0 and it doesn't matter. The most we're going to lose is $400. So this is a much better idea for people who have a smaller account and can't necessarily put up. Even if you've got a $10,000 account, if you just do this, sell this put and you get assigned, you've got nearly half of your account allocated to one stock, which you don't necessarily want to do. So, generally if you've got less than 100,000, you're probably not going to do wheel trades or cash secured puts. You might do naked puts and try to avoid assignment, which is, again, sort of a whole other discussion. But generally, if you've got less than 50 to 100,000, you're going to want to look at spread trades, credit spreads. Then, what we'll do is we'll look at, we'll compare the naked put. We'll go back to the naked put, and we're going to compare a short-term and a long-term trade. Let's go out to September 74. 74 is probably okay. Now I'm going to try and make this as similar as I can. That's got a 30 delta. So I'm going to look at this 30 delta here as our comparison. So that's our short-term option. Now we're going to look at this longer-term one. Much higher premium, 237, lower break-even price, but we've got lower volatility. We're not getting as much bang for our buck in terms of volatility. And our annualized return is going to be a lot lower. Now we're getting a much higher decrease to our break even, which could be good. But we're only getting a 26% annualized return and we're still risking about the same amount of capital. I'm not saying one's better than the other. This one maybe is, to be honest. If you're happy to buy the shares, you're getting a much higher return. These are going to just move a lot slower. So let's have a look. Let's say on our T+0 line, let's say delta drops to 48. On this long-term trade, we'd be down about $140. With this trade, we're still only down about 100. So probably a bad example. It might be better to show you with condors. Robert says, would you recommend setting a stop loss for this trade if you do not have the money to buy the stock? I wouldn't do the trade if I didn't have the money to buy the stock. I don't like trading on margin or trying to risk not getting assigned. And stop losses aren't going to work well, sorry, with this one, the short-term trade, because if Delta has a big drop over earnings, it's going to blow right through your stop loss potentially. So I would recommend not doing this trade if you don't have the money to buy the stock. All right, let's highlight the difference between short-term and long-term trades because that didn't really show us on that one. Let's pick a stock like NVIDIA that doesn't report earnings in the August expiration. I think they're after August 18th. And let's look at a condor. I normally do 15 delta for my condors. So we'll do this as our put spread. And we'll do the 15 delta here as our call spread. That's for August. So a condor is just a combination. I'll just do the one contract actually. Condor is just a combination of a bull put spread and a bear call spread. There's our sort of medium term trade. I think it's about 40 days to expiration or something like that. We're going to generate about $120 in premium, $380 at risk, and we've got a nice looking T+0 line. Let's try and set up a really short-term example to compare. If we were to use the weekly options. Try and set it up as similar as we can. We haven't got a 15 delta, but I'll go with a 12 delta. And there's a roughly 15 delta there. So similar type of trade. One's short term and one's kind of medium term. Let's turn that one off. And we're much closer in. We're generating less premium and we're closer in as well. Let's, sorry, kind of faffing around a bit here, but let's go with bigger contracts and it'll hopefully illustrate the difference a bit better. IB is a little bit buggy. Sometimes we have to reset this T+0 line. Let's say this week, oh, so this should be down here at the 0 line. That's really annoying. Anyway, I don't think this is going to work, me showing you this. So take my word for it. Short-term trades are going to have their P&L is going to move a lot quicker. Anyway, getting sidetracked. So in any case, on a stock like Nvidia, this would be a pretty good trade. August expiration. This is just a bull put spread. Now we're only using one contract, so we're not getting much premium. $60 over 440, provided it stays above 137.5. So nearly $20 it can decline between now and August 15th, and we're going to be good. Now, I talked earlier about setting price alerts, and Robert, you asked about stop losses. Stop losses, automated stop losses with options don't work very well because of the wide bid-ask spreads. They work well with stocks, but not so well with options. So what I do is I set a price alert. Now here in this example, we're generating $60 in premium. If I follow that T+0 line to a loss of about $60, comes in about here, about 149. So I know that if Nvidia stays above 149, the trade's going to be more or less okay. I'm not going to be down any more than about $50 or $60. So I don't really have to watch this trade, provided Nvidia is above 149. So what I'll do once I've entered this trade, and I've got videos on how to enter the trades in Interactive if you want to watch them. I won't get into that now because everyone uses a different broker as well. But in terms of setting alerts, I'll right click on the ticker. I'll go alert, create new alert. If it drops below 149, I'm going to get an alert. I'll just go to advanced settings. Then I'll go next and finish. Alert active until the expiration date of the option, which was August 15th. Okay, and activate. So now I've entered my trade and I've set my price alert. I don't really need to look at Nvidia again unless that price alert goes off. Now I am going to look at it because I just, following the market every day anyway. But if you're time poor, that's a way you can do it. So as long as Nvidia is above this 149 level, we know the trade's okay. And that's pretty much it. And then with my wheel trades, if I was wanting to do a wheel trade and take a long-term position in the stock, I might just do the put. If it comes down below 140, I'll buy the 100 shares and then I'll maybe start selling covered calls against it. Anyone trade the wheel trade here? Let me know. Yeah, Robert, that's perfect. That's exactly what I do as well. So Robert says he sets alerts and saves the exit trade so that when I'm at work, I can pull it up on my phone and sell it or buy it back, close it out. So that's a great idea. So where are we? Let's say we've sold. Let's add our put in. Now this can be any trade, but I'll just use the naked put as the example because it's a bit easier. Let's say we're going to sell that option. We click the bid price. We go towards the mid, day or good till cancelled, whatever. Transmit. Once the market's open, that gets filled. We then we'll set our price alert, and then we can set our closing order, and we can say we might want to buy it back for 50 cents. good till cancelled. That's just sitting in there in the market pending. If our price alert goes off, we can come in here, update the price, close out if we want. So that's a really great process. And otherwise, we're leaving this order just sitting there pending as kind of our take profit order as well. So automated stop losses don't work well with options, but take profit orders do work well. Yeah, Nicholas hasn't been doing the wheel. Robert has with OKLO and doing quite well, so that's good. Not an underlying that I trade, but yeah, it looks pretty volatile. But as long as you're buying the shares low, you're selling calls when it's high, that's good. With my wheel trades, it depends a little bit on the underlying. My DTE. Sometimes the DTE will be really short if I'm taking advantage of that earnings report, such as that Delta Airlines example. Other times, if it's an ETF, it'll be a bit more longer term, 90, 120 days sometimes. So it really depends on the underlying and the scenario. And then I have this wheel tracking spreadsheet. Some of you may have seen the video I did last week, tracking some of these trades. So this one's been going since Feb 2023. Probably haven't really got time to go into all the details of the wheel, but basically you sell puts and you take ownership of the shares, and when it rallies, you sell covered calls, you collect the dividends. So you can see I've bought 1,400 shares at a cost of 32,511. Those are currently worth 37,000, and I've made a whole bunch in options, premiums, and dividends as well. So if I take off the filters, you can kind of see, you don't have to go through all the details here, but we're selling puts, we're getting assigned, buying shares, selling covered calls, buying more shares, we're getting dividends. So what did I buy? I initially bought at 23.09 and it's currently at 26.48. And in the meantime, if we filter out the buys, this is all the option premium and dividends that I've generated. 6,500 in option premium and dividends. So some of these I had to buy, I bought back to close and I rolled them. This one's open, it's in the money because the strike is at 25. So if I don't want to have the shares called away, I'm going to have to buy these back closer to October, so that I don't get my shares called away, because I actually want to keep these shares and keep getting the dividend. And I don't want to trigger capital gains tax either. But look, this is all a little bit more complicated. I don't want to get too much into to this. This is kind of just an introductory webinar, but that's the power of the wheel strategy. You can see the stock was down 10% and my position's up 28%. So anyway, that's a little bit about my process. I hope you've enjoyed that. I hope you've learned a few things. If you've got questions, feel free to reach out. Let me just turn my video back on. Yeah, so look, hope you enjoyed. Happy to stick around and do Q&A if you've got questions. I don't trade options on commodity futures, no. No options on futures. Not that there's anything wrong with doing that, but it's just not for me. I don't do any zero DTE because it's the time difference is just impossible to, I don't want to be up all night. And even if I was based in the US, to be honest, I wouldn't want to be stuck behind a computer all day. So it's just not my style. I have a bunch of trader friends that do and do quite well, but it's not for me personally. Yeah. So you saw with that EWA example, I've sold the calls out to October, so that's a couple of months away. That's more my style with the wheel trades at least, and then credit spreads condors will be a little bit more shorter term. Gary says, do you manage losing strangle by moving up the losing legs? Will you invert the strangle? I don't do a lot of strangles. I tend to do more condors. But yeah, generally again, we could probably do a whole hour or two on adjustments, adjusting condors, but I'll roll roll the tested side. So defend the tested side. Sometimes I'll roll up the untested side as well, or just roll the untested side, or just roll the tested side. It really depends on the scenario. Another adjustment strategy I use is to delta hedge with the underlying stock. So a few things there, but yeah, I don't do a lot of short strangles just because they're naked options. Prefer to have the risk-defined trades like condors and credit spreads. Settings for the bar chart screeners, I'll put them in the video description when I send out the replay. Yep, good call. Any other questions? Feel free to fire away. I hope you enjoyed the session today. Hope you learned a few things, and welcome to the community. Happy to help anytime. So just reach out, email, Twitter, whatever your preferred method is fine. But if that's it for questions, we might leave it there. So yeah, have a great day or evening wherever you're based in the world. Thanks for joining, and reach out anytime. Thanks, Robert. Thanks, Gary. All right, take care, everybody. I'll talk to you soon. See ya.